When economies become unstable, markets crash, and uncertainty spreads, people start asking the same question: where is the safest place to put money during a crisis? The answer isn't always as simple as one perfect investment, because safety depends on inflation, debt levels, market conditions, and how severe the collapse becomes. Throughout history, investors have turned toward assets like cash reserves, gold, government bonds, defensive stocks, farmland, and essential industries during uncertain times, because they tend to hold value more reliably when fear takes over the market. Today we will talk about the safest investment during economic collapse. So, before we get started, make sure to hit that like button. Also subscribe to my channel. 10. Economic collapses change how people think about money. During stable economic periods, most people focus on growth. They chase higher returns, invest aggressively, take larger risks, and assume financial systems will continue functioning normally. But when economies begin collapsing, priorities change completely. Suddenly, people stop asking, "How much money can I make?" and start asking, "How do I protect what I already have?" Fear replaces optimism. Stability becomes more important than speed. Investors begin searching for assets capable of surviving inflation, banking instability, market crashes, currency weakness, unemployment, and financial uncertainty. 9. Cash feels safe until inflation destroys it. One of the first reactions during economic uncertainty is holding cash. People feel psychologically safer when they can see money sitting inside bank accounts or savings. And in the short term, cash does provide liquidity and flexibility. But during serious economic collapse, inflation often becomes a major threat. As prices rise rapidly, the purchasing power of cash begins shrinking quietly over time. This creates a dangerous illusion of safety. A person may technically still possess the same amount of money, but that money buys less and less every year. 8. Hard assets become extremely important during crisis. One pattern repeats throughout financial history. During periods of instability, investors often move toward hard assets. Hard assets are physical things with real-world value that cannot simply be created endlessly by governments or financial systems. This includes assets like farmland, precious metals, productive real estate, energy resources, and essential infrastructure. People trust these assets during crisis because they remain connected to basic human needs, regardless of financial conditions. 7. The safest investments usually generate real utility. One major mistake many investors make during economic fear is focusing only on price movements instead of utility. Truly resilient investments are often connected to things society cannot function without. During economic collapse, luxury spending may disappear, speculative markets may crash, and financial bubbles may burst. But essential systems continue operating because people still depend on them daily. Investments connected to necessities often survive better because demand remains durable even during crisis. 6. Diversification becomes more valuable than prediction. During stable times, people often become overconfident about predicting markets. But economic collapses expose how unpredictable financial systems truly are. This is why experienced investors rarely depend entirely on one asset class alone. Diversification becomes critical because no one knows exactly which sectors or markets will suffer most during severe downturns. Investors seeking safety often spread capital across multiple asset types capable of responding differently during crisis. 5. Debt becomes dangerous during economic stress. Another important reality during economic collapse is leverage. Debt can accelerate wealth during boom periods, but it becomes extremely dangerous when economies weaken. Job losses, declining asset prices, rising interest rates, and shrinking cash flow can quickly turn debt into financial pressure. This is why many experienced investors prioritize strong balance sheets, and manageable financial obligations during uncertain times. Safety often comes less from chasing extraordinary returns and more from avoiding catastrophic financial vulnerability. 4. Human psychology changes markets during crisis. Economic collapses are not driven only by numbers. They are driven heavily by fear. Panic causes bank runs, market crashes, emotional selling, and irrational financial behavior. During these moments, assets viewed as safe attract enormous demand because people desperately seek stability. Investors who understand psychology recognize that confidence itself becomes a financial force during crisis. 3. Productive assets usually recover faster than speculation. One lesson repeated throughout history is that productive assets tend to recover more reliably than purely speculative assets. Businesses generating essential goods, productive land, infrastructure systems, and companies solving real-world problems often regain value because economic activity eventually stabilizes around necessities again. Speculative assets dependent entirely on hype or easy money may collapse permanently once confidence disappears. Experienced investors focus heavily on whether an asset produces real value independently of market excitement. 2. Long-term thinking matters most during panic. Economic collapse creates emotional pressure that causes many people to make destructive decisions. Fear encourages panic selling, emotional reactions, and short-term thinking. But long-term investors understand that financial crises are temporary phases inside larger economic cycles. The safest investment is often not the one producing the fastest short-term returns. It is the one capable of surviving uncertainty while preserving value over many years. Patience becomes an enormous advantage because markets eventually stabilize, economies adapt, and productive systems recover over time. Investors capable of remaining rational during chaos often emerge strongest later. 1. The real safest investment during economic collapse. The deeper truth about financial safety during economic collapse is that protection rarely comes from hype, speculation, or chasing perfect predictions. It comes from owning assets connected to essential human needs, productive systems, and long-term real-world value. Because the truth is simple. Economies may weaken, currencies may fluctuate, markets may crash, and financial systems may become unstable. But humanity will always depend on food, shelter, energy, infrastructure, healthcare, and productive resources to function. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.